Debt is temporary, equity's forever. E- Equity is kind of like a marriage. Once you sell equity, once you sell a piece of the pie, that piece is now gone. And if you're going to raise money, especially from an institutional investor like a venture capitalist, that is like a marriage. That's a 10-year plus journey. So you got to get in with the right people, and you're also giving away a big chunk of the pie. And that works really well in a lot of instances. And I think, venture capital is very much needed, especially for early stage companies where you need real risk capital and people to take a lot of risk and get a lot of upside. Otherwise, we wouldn't really have any innovation. Then you have, at the other end of the spectrum, you've got banks who want profitability, they want property backing, they want personal guarantees and all that type of stuff. And where we play is somewhere in the middle. So we're sitting there going, okay, we've seen enough to know there's something here. We have some assets, some combination of hard and soft assets that we can look at to hopefully cover our debt. But we can take a little bit more risk than a bank can, but much less risk than a venture capitalist or an equity investor. And for that, we'll get a much tinier piece of the pie, but we'll get paid out first out of the assets of the company if it's sold.